Well, hi folks, and another Tuesday evening. Great to see you all here. We'll just put the pre-show on for a moment or two, and been an interesting show tonight. It's just me, of course, just talking a little bit about some of my work, particularly looking at the surveys and some of the analysis we've been doing. There's a lot to talk about there, and we'll also contextualize it with some of the other information that's just come out recently, which paints a rather concerning picture generally as to what's going on. And as with all of these things, there's always more things I'd like to chat about, but it's finding time. Cookie Boy sent me all this anti-spruik stuff the other week, all that research. I haven't yet put into a show. I will. I'm just trying to get around to it, so give me a little time. And of course, the old doggies are round and about. So this is doggy heaven. They've had their lunch. They've run in the garden, barked at everything, and are now having a little zuzz while I do the show. I worked out quite quickly that the only way to keep them quiet was to feed them before the show rather than actually afterwards, because they got hungry about halfway through and then started to nudge me. So that's why they get their food early on a Tuesday. But they're looking pretty comfortable, and they are enjoying the UK weather and environment, and the squirrels are amazingly buoyant at the moment, bouncing through the trees, so I think that's great fun. Anyway, that's enough preamble, I think. Take the pre-show off. I'm now going to start the show formally. I'll be back in just a moment. Well, good evening and welcome to this live stream. And once again, we're here on the Tuesday evening on the 12th of September 2023. It's Martin North here from Digital Finance Analytics. Thanks very much for taking some time out of your Tuesday evening and spending it with me. And we're going to talk some very important information today based on my modelling and survey. So no guests, just me. But I think there'll be plenty to discuss. And in fact, we're going to run the show in three pieces. The first piece will be some of the newest economic data that's just out. Then secondly, we'll look at my financial analysis, specifically around mortgage stress. And thirdly, then we can do some deep dives into postcodes if people are interested. And if you've got a particular postcode you're interested in, we'll look at it then. So keep those postcodes around, but don't throw them at me yet, because I won't be looking at the chat over the first part of the show. Just before we start, let me just remind you, as always, that we don't provide specific financial advice here. This is a general conversation only. We do also moderate the chat, so please play nice, but do encourage you to make as many comments as you feel you'd like to. And I don't necessarily engage in all of the stuff that's in the chat. There's just too much going on, but I'll do keep an eye on it, of course. And as I say, it is moderated. This is as at the 12th of September 23 if you're watching in replay. And if you'd like to get my attention or ask a question, if you use @WalkTheWorld, That then means it gets into my queue. Once it's in my queue, I'll have a greater chance of seeing it. I've also enabled Super Chat, and that means you can get your question to the top of the list if you'd like to do that, or indeed, if you'd like to make a contribution to what we do around here, always greatly appreciated. We don't do this to make a profit. We do this because we think there are some really important discussions to be had. And in that vein, let me start with some initial discussions around some of the discussions that are driven off the latest economic news. I just noticed there's a question from MK. I'll just put that up there. Yeah, I'm actually recording a show with John after this show. So it's been quite busy on the ASIC front, and we haven't been able to make a show because of it, but there's a show recording today. So expect to be it on IOTP over the next 1 to 2 days. All right, so let's just start with some basic information about what's been going on. I thought we might start with this information here. This is actually based on the overseas arrivals data that was published today from the ABS. Preliminary data, of course, for August, but it shows another very strong number. So we have a lot of people coming into Australia from overseas. There's also a bit of a spike in departures too. That's to do with holidays, but of course a lot of it's more concerning in terms of long-term residency. In fact, the ABS expects the population growth to continue very, very strongly. And you can see there that the change in persons and the percentage are both, well, higher than they've been for a long, long time. In fact, if you go back right the way to 1975, it's never been higher. So there's a huge spike in terms of the number of people coming into the country. And that's one of the reasons why the property sector is so weird as it is at the moment. Another way of looking at it, this is actually based on the CBA data. It shows you about the annual population growth, and particularly the 15 plus population monthly, as well as the total population quarterly. And what you can see here is that the government projections were going one direction, that's the green, but in fact population growth is dramatic. And just another way of looking at it, this is the temporary visa data for Australia, and you can see there that the total in March 2022 was 1.8 million visas issued. In July 2023, it's 2.5 million visas issued, so a very significant change. And if you look down the numbers, there's some very significant spikes, particularly in the student numbers, where they've more than doubled over that time. Some temporary holiday workers and other temporary categories too. So across the board, it's pretty concerning, really. Just where are they going to put them all? And thanks to Cookie Boy for this one. Rental crisis deepens as vacancy rate hits a record low. Of course, one of the issues is where are people going to live, and the vacancy rates are very, very significant. The national rental vacancy rate hit a record low in August as elevated immigration inflated the tenant pool at a time when more landlords are selling up. And on the selling up side, this was titled The Big House Sell-Off, with investors. A quarter of Melbourne property investors sold at least one rental home in the past year. And that's pretty consistent with what I've been seeing. I reckon there's about a 25% drop in total investment properties on the market for rent relative to where it was pre-COVID. And there's three factors. One is some investors are selling, particularly older properties where they can't actually afford to get them done up, or indeed the rentals can't be lifted. Secondly, we've also got another factor, and that is a lot of people switching to Airbnbs, so taking them off the rental market for short term. And the third factor is that there's been a bit of a tweak at the moment in terms of what is actually going on. So as I've discussed with Edwin, some properties are being rebuilt, for example, multiple single rooms, which are then subsequently let. So the mix of property has also changed, which means that there's been a reduction in the number of houses that are available as a single unit. A lot of houses are being subdivided and offered as single rooms, and that is also changing the tenor of what we're seeing in terms of the rentals at the moment. And I don't see there's going to be any reason why that's going to change. All of the discussion about 1.2 million houses over 5 years, or 30,000 concessionary houses over 30 years, it's not going to touch the side. The vacancy rates are also pretty concerning. This is from PropTrack, and you can see there the significant changes. It does vary, but you can see pretty much wherever you look. Sydney down 60% since March 2020. ACT up 87%. So it's not a universally bad story. And of course, there's some interesting points in the ACT about the fact that rents are more controlled there. But look across the board, quite significant changes in the vacancy rates. And that is also lifting rents. The rent in the CPI is a lot lower than the CoreLogic advertised rents. That's because the CPI is all rents, including those that are older rents, whereas the CoreLogic is advertised rents. But the assumption is that those are going to flow into the CPI. So it does explain the significant pressure on rents. And of course, the rent is a big issue in the CPI. Now, here is the total value of dwelling stock in Australia. And this again came out today from the ABS. The total value of residential dwellings rose to 10 point just a bit trillion this quarter. The number of dwellings rose by 52,000 over the quarter, just over 11,000. And the mean residential value rose by $25,000 to $912,000. So a very interesting story there. More people coming into the country, not enough stock, and therefore pressure on the markets. Now, another way to think about pressure is to look at what's happened to interest rates, and this is from CanStar. So interest rates have gone up dramatically. So if you think of a $500,000 loan in April 2022, that was costing just over $2,000 a month. Now it's $3,300. That's a total change of more than $1,200. And if rates were to go up again, it would be up above $3,400, which will give us a change of $1,301. And if you look at $1 million, it's the same story. Very significant rises. A $4,200 a month payment is now closer, potentially, if rates go up again, to $6,800 a month, which is more than 2,603, and those are averages, and it's based on an assumption that the original loan was 2.98. We know that a number of people actually had loans closer to 2%, so it shows you just how significant these hikes are. And another way of looking at this is the ABS data relating to the debt servicing costs, and the share of disposable income and the amount just going through the roof, which is concerning, and now touching territory that we haven't seen for many years. Of course, it's also got the fixed rate expiries continuing to roll off, and it's worth just pausing to think about the fact that CBA says the rates which the refinancing is continuing. We're not all the way through yet, but of course the interest rates are a lot higher, and that's putting a lot of pressure on households too. And they also said that there's still a sort of a lag effect, so interest rates rise, but it takes time to work through, so it's not all through yet, and that's shown in some of the spending as well. Talking about CPI, the national petrol and diesel prices gone up dramatically, so we're seeing further rises there, so there's more CPI pressure. And interesting, if you look at the price deflation to inflation, you can see there that the unleaded percentage is up very high again, so that's another signal of pressure ahead. Now, because of all of this, confidence dropped again, fell 1.1 percentage points according to Roy Morgan that came out today, and still languishing in territory that, we've not really only seen other than COVID, which was just a short spike. This is very significant now, the amount of pressure on households, and the confidence is very low. Translates also to retail sales, and there's a bit of a dip happening now. Roy Morgan thinks that we're going to see more slides ahead because people don't have the money. Some do, but many don't. And the other thing that we highlighted earlier in the week was that we've now got multiple job holders, unemployed people. More people are working multiple jobs, more hours to try and get by, and working specifically multiple jobs. So that's a significant concern. Particularly younger people are having to work harder and longer. And as I said in an earlier post, work until you drop. Now, there's some other data that came out that showed that the business survival rates are dropping, and more than 15% of Australian businesses failed in the 22-23 financial year. Small enterprises were more likely to fail than large businesses, and in fact between June 2019 and June 23, 35% of all Australian firms closed their doors permanently. Very significant falls. I'm seeing that in my SME survey. And talking about vacancy rates, it's interesting if you look at the CBD vacancy rate. So this is now not rents or rental properties, but this is actually commercial property. You can see there that the vacancy rates are very high, and there's actually significant impact there in terms of what's happening with regards to the commercial property sector. And a lot of high vacancies in New South Wales, which suggests we're going to see significant pressure on the commercial property sector. Now, before I go on further, of course, we're going to talk about my core model. I'll just have a quick look at the chat to see whether there's anything that I want to cover on before we move on. Thanks for all your comments there. And Down Under Drove said at least rentals won't drop in a hurry. Well, that's probably true. The trouble is, of course, we've now got to the point where people can't afford to pay higher for the rents, and I'll show you the rental data in a moment. It's really quite significant. Sandra says that Andrews was trying to blame it on interest rates, selling one of their properties. It's an interesting question. Vanessa asked, is it now safe to build new, or are building companies still going into administration? The highest proportion of failures among businesses now are amongst construction sector. So no, they're still going. There was one in Adelaide that went wrong and was announced overnight, which basically is another 200, I think, homes still under completion and won't be completed easily. And of course, the trouble is that as more and more builders get into difficulty, you've got more part finished homes around the place. And that's actually a really, really big deal. As Down Under Drove said, the CoreLogic cost of index has risen. Absolutely. Building costs are rising. The costs of paying people to work in the construction sector are rising. And you've also got quite a large now construction activity funded by state and federal activity. So there's a complete contention between that and some of the construction work, where quite often the construction was done on very much on the sort of fixed price basis, and then suddenly, of course, the costs have risen through the roof, so builders are completely caught. No, Cookie, you're wrong on asbestos. Asbestos is harmful, and you cannot just ignore it and keep it painted and don't drill. Nothing will happen. It fails. And we're actually now in the situation where the failure rate from asbestos that was established in the 30s, 40s and 50s means that you can't just rely on being it painted, I'm afraid. It's just too flaky. And in fact, in the UK, there was a report done last year by Parliament in the UK that showed that, again, around 1/3 of properties in the UK, like Australia, have asbestos. And they also made the point that it's no longer an argument to say you can ignore it, you've got to deal with it. And they actually put a plan together to suggest that asbestos should be removed over the next 20, 30, 40 years. And there's also this thing about the rack concrete, which is another UK problem. So that's the aerated concrete. And what they're finding is a lot of properties that were built in the 50s, 60s, 70s, 80s and 90s were built with rack and also have asbestos. So they've got these two issues now which they're wrestling with in schools, other public buildings, and of course potentially in the private sector too. So it's yeah. And off topic, whatever happened to your three-legged pup? Yeah, that was Winston. So Winston died about 4 or 5 years ago at the age of 17. So he had a good innings. One of the reasons why we got the 2 dogs we've now got is they were a replacement for Winston, who was very much Jill's companion dog in the early part of her illness. So we got these other 2 dogs, and of course I've then brought them to the UK. And I've just got to show you this. Sorry, this is just hilarious. So Meteor has now been pushed out of the beds, and Luna's sleeping in both of the beds together. It's hilarious, really. Okay. And Rolf says, hate asbestos, absolutely. Well, Jill died from mesothelioma. There's about somewhere between 4,000 and 8,000 people dying each year from asbestos exposures, and unfortunately more of it's now women, and more of it directly linked to DIY. So it's very, very, very concerning issue. Governments don't want to talk about it. I'm still lobbying through the asbestos awareness program, but governments don't want to talk about it. It's too big a risk. And commiserations, Cookie, 19, great age, but when they go, it's still very, very sad. And indeed, drywall from China has up to 5% asbestos, absolutely, and there's a lot of that cheap construction in Australia at the moment using imported materials which are not even being checked on the way in. So it's not a sleeping issue from the past, it's an active issue now. And in a lot of the high-rise construction over the last few years, that drywall has been used. It's got asbestos in it, and if you sort of drill a piece of the drywall to hang a picture or something, you could be making dust. That would include asbestos. And just to remind you, you only need 1 or 2 fibres. It's not something you have to be exposed to over a long period of time. 1 or 2 fibres on one occasion are sufficient to create a problem that only will appear 20 to 30 years later. And unfortunately, the prognosis is still pretty poor. There's no real treatment for it. And the real scary thing is that nobody really wants to talk about it. So if you're thinking of buying a property and if you're thinking of renting a property, it's worth asking the question about asbestos, as I've been talking about with Edwin recently. Okay, I think that's pretty much caught up with the chat, and we'll now go on and talk specifically about the stress material. Just to remind you that we do this through our core market model. We run our rolling survey. It's part of the Omnibus server. We get data back each week, and from there we then do the analysis to be able to figure out what's going on. And that means that we can slice and dice the data all sorts of different ways, like a Rubik's Cube, as I sometimes say. And we can also then think about what the scenarios might look like and how the scenarios drive into what might happen ahead. Scenarios, not a prediction scenario. So we look at mortgage stress, we look at the price trajectory, we look at the buying and selling intentions, the migration data, and the economic data, bang it through the core market model, through our scenarios. And we can look at the end of the postcode level, up to a region, state and all Australia level, and we can also make a view as to where scenarios might tell us that prices could move in the next 2 or 3 years. And by the way, just on this, we're still running the one-to-one conversation. If people want to have a more detailed conversation with me about a particular suburb, it's an individual confidential discussion. Can't give financial advice, but I can tell you about what's going on with the data. And we can look at the stress, the home price data, the trend data, and talk about where things may be going based on the modelling. And we can have a conversation up to an hour by Zoom or on the phone. And there's a fee involved simply because there's quite a lot of work to do and research to do to be able to put it together, payable in advance. And typically we're booking 3 to 5 weeks ahead. So if you're interested in that, go to the blog. You can contact me via the blog and get more information and progress the conversation. Definition of stress is the next thing I just want to touch on again. Really important to understand that stress is, in my world anyway, looking in terms of cash flow. There are other ways of doing it, 30% of income, whether it's taxable income or not, or some underwriting metrics like the banks use, but we define stress in terms of cash flow terms, money in and money out. If households have more outgoings, it's excluding one-off discretionary items than income, then we define them as stressed. If they have a mortgage, then they're in mortgage stress. If they're renting, they're in rental stress. Investors with cash flow pressures are identified as stressed investors. And we can look at the data to estimate the total financial stress. That's across all the categories. And then we express it as a percentage of households and account. As I've explained before, I think the latter is a better measure of count because it shows you where the big problems are. For example, you can have a very small postcode with a very high level of stress. That's not going to have the same impact as a very large number of households in another postcode where there's even more people in the postcode. And now let's look at the mortgage stress data for August. This is the latest. This is updated to August. And the first thing to observe is that rental stress has continued to go through the roof. It's now 70.54% of renting households have a cash flow problem. You can see it's gone up dramatically in recent times. It was going up roughly in line with mortgage stress up until COVID, and beyond, but then it really started to accelerate, and that acceleration is pretty much plumb with where the high migration started to come in. And of course, interest rates started to rise. Now, mortgage stress is 49.6%, so not quite half of households with a mortgage have cash flow issues. But compared with February 2020 before COVID, where it was 32.9%, this is much, much higher. So that's a considerable issue to bear in mind. And interestingly, of course, the debt-to-income ratio is still high. The RBA keeps restating it because of data changes from the ABS, but still climbs. And as I always remind everybody, this is not necessarily showing the true position. It's showing it about 187 or 1.8 times. In fact, of course, the truth is that this includes everybody not borrowing, everybody renting, and SMEs. So you need to multiply at least by 3 times to get to the debt-to-income ratio for those with a mortgage. Now, this is the data for August. And what I've done here is I've highlighted in yellow the percentage movements when they've gone up, and in blue where they've gone down. So you can see there that from mortgage stress, only in New South Wales and Victoria has it dropped slightly. The reason it's dropped slightly is because of people able to refinance, and the banks have been very generous with extending loan terms, in some cases out to 35 and 40 years now, to try and get people through, or interest only. And that's particularly true in New South Wales and Victoria, where there's a lot of pain. So that drop in mortgage stress is more to do with the underwriting changes that have been brought in and the bank's ability to try and help. Everywhere else, pretty much, ACT, Northern Territory, Queensland, South Australia, Tasmania, where we've got the highest in the country at more than 64%, and Western Australia, all high, and the overall just 49.6. Rental stress is also growing in a lot of areas, particularly in New South Wales and in Victoria. And you can see there that New South Wales is up to 78% now. It's horrendous. And Victoria is at 70%. The average is just over 70%. But you can see there in a couple of other areas, things are not quite as bad. In the Northern Territory, there's some unique situations there, but partly because it's just such a low sampling rate. I'm not sure how accurate that one is. If we look at investor stress, you can see there that there's still rising investor stress. So this is investors who've got not enough coming in from their income from the rentals to cover the costs of managing the property and paying the interest on the mortgage. And so that's a problem. They end up potentially selling. And then financial stress is the aggregate. So that's against all households. And it's 48.49% of all households. So it's just under half of all households have financial cash flow issues. And that's based on nearly 10 million households across the country. So it's pretty concerning. I will briefly just touch on the next dimension, which is looking at it by segment. And you can see there that the young growing family segment, the one at the bottom, that's a lot of first-time buyers, have huge amounts of mortgage stress, up to 90% now, huge amounts of rental stress, 76%, and overall financial stress is very high. Young affluents, less mortgage stress, but a lot of them have investment properties, and some of those investment properties are not performing very well, but also they've got very large amounts of rental stress because they're often paying very large amounts to live where they're living. And we've also got first-generation Australians, I call them multicultural establishment, where in fact those have come into the country and have gone into the rental sector. 81% of those are actually struggling with the rents at the moment. And even more stable families are also pretty high too. And overall, you can see there that it's the battling urban, people on the outskirts of cities that are also struggling, and you'll see that in some of the later data. So they are also very highly exposed, and the financial stress is also very high, as are amongst young growing families. Okay, I'll briefly go through the data just to show you where the top by count of mortgage stress is. So Liverpool, Campbelltown and Toowoomba, the top three, they've been pretty much in that position for quite some time now. And then we've got Western Australia tapping, a Victorian postcode like Donnybrook and Craigieburn and Roxburgh Park, Narre Warren, back to New South Wales and Camden, and a few other places too. As you go down the list, they're Cranbourne. Now, quite a few of those are actually high growth corridors, a lot of new building going on, of course. We've also got Ballarat, as well as Toowoomba, so regional areas as well, who are feeling it. If we look on rental stress, the centre of Melbourne's still there in number one position. And there's a lot of pressure there, 15,000 in rental stress. Then we go to Liverpool, Toowoomba. Then we go to places like Westmead and Wentworthville and Zetland. Then Hobbs Crossing and Tarneet, and a few others too. Jerry, thank you very much for the super chat there, which I appreciate. And we'll also get to your postcodes that I saw you put in just shortly. But I just want to finish this part of the show first before we get into details. Otherwise, I'll never be able to finish the story, if that's okay. Okay, so you can see that that's pretty concerning. Blacktown down the bottom, then Fortitude Valley in Queensland. Now, if we then move to Western Australian postcode, Wembley is where stressed investors are hanging out, plus Queanbeyan, plus Melbourne, plus Westmead and Toowoomba. So a slightly different storyline in terms of where the stressed investors are, but you can see that some of those postcodes like Blacktown are showing up, plus Surrey Hills and Ferntree Valley in Victoria, South Bank in Victoria, which is the yin and the yang from the earlier data as well. And even places like Crow's Nest and Greenwich in New South Wales is also showing up too. And then finally, financial stress, Liverpool, Toowoomba, Campbelltown, then Cranbourne, then Roxburgh Park, then the centre of Melbourne, then Tarneet and Westmead, and then Derrimont, Mount Druitt, Ballarat. So you can see here that the financial stress is really built up down the east coast. Western Australia is featured by Tapping, 6065, down the list there, plus Ipswich in Queensland as well. But it is very significant now. And financial stress is pretty much everybody. Cookie asked a question, which is good. Any chance you can make a highest percentage split into metro and regional postcodes? Yes, I could. I've got all that data. I can't do it on the fly, as it were, but maybe I'll make a separate show about that later. It's a good suggestion. As with the analysis, there's always multiple ways that we could actually look at it, so thank you for that. And Down Under Drive says, it will get worse until the last quarter of 2024. Yeah, I mean, it is worth just bearing in mind, of course, that we are going to see interest rates probably go slightly higher, stay high, and maybe drift lower. But the drift lower is not certain yet because, of course, we've got the problem of inflation, oil prices coming back higher, the energy prices going higher, the other factors that we know about too are all pushing a little bit up in terms of where inflation may be going. So whilst we've seen inflation come down a bit, it may have to go up a little bit. And that's going to put more pressure on the RBA to lift higher. So I'm of the view that it's going to get worse, certainly until the end of 2024 and probably into 2025, which is not necessarily good strategy, but it is unfortunately what's likely to happen. And the question, of course, is whether there's been a delay in terms of interest rates hitting the real economy or not is a big question. There's a lot of people who are actually arguing that, well, maybe rate have passed through already, and we've seen the impact, particularly in the US. But in Australia, I think, as the RBA says, there's a lag, and that lag is roughly 12 to 18 months, so you'd expect that to continue. And as I showed earlier on, there are still a number of fixed rate loans that are going to flip over, so it's definitely going to continue, unfortunately. So if we continue my meander, I did actually have one other chart which I just wanted to share with you. Now, this is a bit preliminary, but I'm showing you now the risk of default analysis because that's something else I do. And what I've taken at the moment is the percentage risk of default. This is 30-day default, not 90-day default. So this is people and now risking default. And I'm starting to monitor the risk of default. All the official data is showing defaults are rising. Well, I've got now probabilities that are significantly high in some areas. So, for example, in Wide Bay Burnett, significant defaults, even if it's a relatively low number. Whereas in Wembley in Western Australia, we've got 460 that risk default, which is 13.8% of those with a mortgage. So you can see that at the top of the list, a lot of them actually in Western Australia. And that's because defaults don't happen overnight. It takes a few years for it to work through. And we still had very high prices in Western Australia in 12, 13, and 14. And then, of course, it went backwards and sideways and down. So a lot of those are defaults from a long time ago, but now interest rates are rising, which means people are being bitten by them. So you can see there a lot of WA, but then if you go down the list, you can see some defaults also in other areas too. Now, I've sorted it here by the percentage defaults. As I'll show you later, there are quite a few other ways we could slice the data. But I will also highlight the fact that if you look at my segments, you've got exclusive professionals and wealthy seniors, as well as suburban mainstream and disadvantaged fringe, and then rural family, young growing families. So my point is that this default story is touching quite a few different types of households. And my view is that we're going to see this really work through. It will take a lag. It typically takes 2 to 3 years for people who've got cash flow issues to either sell, a lot of people are selling, or to default. So watch this space. But I will be reporting this now on a more regular basis. I think it's a very important angle of attack, particularly with what we're seeing at the moment. Now, just briefly, let me talk about my scenarios. And as I do that, we'll remind you, please, to like the show. Very important that we get this message out, because there are some incredibly important decisions that people can take to alleviate some of this, but only if they're aware of it. So by liking the post, you can get the message out through YouTube. So please remember to like the show. Now, in terms of scenarios, let me just highlight again, our scenarios are ways of exploring the future. They're not forecasts. They are helping to get a debate going about what may happen, and therefore none of the scenarios may turn out to be right. Things change. And we use this particular framework then to drive the potential outcomes, and we update it each month, and we'll be able to show you some of that a bit later. To move that forward, we'll look at our 3 different scenarios. So the first scenario is what I call the Goldilocks zone, which means that rates don't go any higher. They stay at 4.1% full next year. Inflation eases ahead of the RBA expectations, and wages rise faster, and there's no recession in Australia. So that's pretty much the best it could possibly be. Wages, of course, growth is easing back at the moment, and inflation looks to be reasserting itself. So we'll see. The base case is a soft landing, so rates go up to 4.35%, which would mean mortgage rates at 6.75 to 7.5% stay high through 23 and 24. Inflation stays above target until 25, but no recession in Australia. So that's, if you like, a soft landing. It's one that is conceivable, but quite hard. And the worst case is the nightmare scenario. So we've got the rates going up, maybe to 4.35%. So those mortgage rates are up 7.5% plus. They stay high into 24, along with inflation. Wages growth stalls due to the recession, which comes here. And then they start cutting rates. But of course, it's all too late, and therefore we get a significant crunch. And of course, we can overlay there recession coming through from deflation in China, and maybe also recession in the US. I still think the US has a chance of into recession. What we'll see. Now, just to show you how this works in practice, this was actually a sample from April where I put all the information together, and what we can then do is we can pretty much look at all of the various aspects of this and look at where the scenarios map through to. This is just one from Wollongong. I'll show you another one shortly, but I thought I'd just show you that. That's the culmination, if you like, of all the analysis that we do down to a postcode level. And in the third part of the show, I'll look at specific postcodes if you would like me to, and we can look at that. However, before we do that, what I want to do now is I want to just spend a little bit of time on the geomapping, because I actually think that geomapping is quite a powerful way of looking at some of this stuff. So to do that, this is actually the geomap for Melbourne. And the thing about geomapping is it gives you a bit of a flavour. Now, I've updated the software here. This is the latest edition of Caliper, which is the software that I use. But you can see here some very interesting observations in terms of the more yellowy, orangey, reddy postcodes are the ones in more difficulty. And you can see here that around the centre of Melbourne, there's a few. But if you go out, you can see to the east, around Pakenham and places like that, north, and also to the west, and indeed Ballarat's just showing there on the edge too. it shows you that there's a lot going on. And in fact, if you pull out a bit further, you can see it in even more detail. You know, there are quite a few areas where things aren't too bad, but there are also quite a few hotspots. And the point I want to make here is that mortgage stress is not equally represented in every postcode. It does vary. And, you know, if we look at another postcode, so let's go to, let's center on Sydney, so let's go to 2000. And do the same. So we'll start by looking close in, and then we'll start pulling out. And as we do that, we can see that, you know, looking close in around the center, it's not looking too bad. Mossman is actually registering a reasonably high level. This is based, of course, on counts of people. And then if you look around Greenwich, Lane Cove, Meadowbank, Parramatta, Ashfield, and then if you come south to Rosebery, Beaconsfield, or even North Bondi, you can see a bit there, Randwick. And as you pull out even further, you can start to see the story developing. And then you start seeing some of the worst effects. Liverpool, of course, jumps out, as you perhaps not be surprised. And then places like Camden. And if we drop out a little bit further, you can see that the Blacktown area as well to the north is also impacted. So you've got this ring of fire, as I call it, around the western suburbs. It's nowhere near as bad closer into the eastern suburbs, but there are some pockets there that are actually quite concerning. Now, if we were to look in Brisbane, a bit of an interesting story too, because in and around Brisbane, there are some areas doing okay, but we've also got some areas where, in fact, the problems are beginning to build. So, for example, Camp Hill, around there. And as we move out further, you can start to see Ipswich coming in. That's the one round there to the west. Geebug and Apsley to the north. And if we drill out slightly further, you can start seeing that even places that you perhaps would think would be okay are also heating it now. Logan, Redland, for example, and down to the Gold Coast. Now, this, of course, has a different population basis compared with Sydney. So if you start to see some of these darker colours here, you may not ever get up to the very darkest red, because this is a national average, and of course the population density is lower in Queensland. But you can see there places like Ipswich and then Toowoomba, as well as closer in, are in difficulty. And just to continue that story for a bit longer, if we go to 6,000, so we'll go to Perth, and once again, as we do that, you can see the story. It's not too bad closer in around the centre of Perth, but if you go out of Perth, you go south towards Canning, or you go up towards the areas around here, Waterman Bay and places like that, you can start to see some of the orange and red. Wanneroo stands out. Well, that was in the earlier data, so, and then Coburn as well. And you can see there that a lot of the issues are on the coast or just in from the coast. A lot of new development, a lot of high-rise closer in, but also a lot of low-rise spread out. But when I say spread out, what I mean is crammed in, almost very small plots. High density, but low-rise development. And unfortunately, the story is continuing to play out as I expected, that you're seeing a lot of these coastal areas. And of course, Rockingham down there is also registering interest. Of course, Rockingham is going to be the place where the nuclear subs are going to be bedded in due course. So at some point, there's going to be significant extra demand for housing in and around that area. So that may change the dynamic there, but not in the short term. And it is pretty interesting just seeing how all of this plays out. But again, it is not uniform. And what I will do this quickly, show you the rental stress, because I can also do the same story on rental stress. And this is Melbourne 3000. Do you remember I said to you that Melbourne was hot, hot, hot? So you can see there that it stands out like a sore thumb. But rental stress is also significantly represented. And as we pull out, we start to see significant pressures over in the Wyndham area. Now, one of the interesting things about this area, this is one of those areas where we have a lot of first-generation Australians coming in, and they're either buying or renting. And quite a few of them are now in significant difficulties. And, maybe it's not surprising to see that, but it is significant that these pressures are very, very concerning, and it's very much bedded in certain areas. And in fact, down under, Drover said, very high new Indian households in the burbs of Melbourne maxed out, being told. Yeah, that's true, and that's true over in the Wyndham area as well, and also in Ferntree Gully too. So there's a few areas where those same things play out. Now, I could spend a lot of time on the geomapping, but I'm not going to do that at the moment, insofar that it seems to me that it is quite important that we get on and talk about some of the specifics and look at some of the household stuff. But these geomaps are very, very important to be able to actually see what's going on. And one of the things I'd say is that if you look at the story in terms of the geomapping, you can see, sorry, I realized that I didn't show the geomaps earlier. Sorry about that. I was talking to the maps, but I didn't put them up. My apologies. I will just quickly, this is the rental stress one. Let me just go back to the mortgage stress, and I will actually just show you the sorry, trying to do three things at once, and guess what? I forgot to show the show on screen. Bit silly really, but there you go. Trying to do too much. Okay, open recent worksheet, mortgage stress. Okay. All right. So that's the Melbourne equivalent for the mortgage stress. Hopefully you can see that now, and you can see what I said about the areas to the north and places like that. And as you pull out, you can see that the story like Ballarat comes into view too. And if we go to Sydney, sorry, this is a bit repetitious, but at least you can see the maps. It'll be helpful, I think, for people. And it also means that what I can do when I make the edited highlights of the show, because I can put the maps back in as well, so that makes it easier for everybody later. There you go. That's the Sydney story, and you can see there that the Ring of Fire to the west is very significant. And if I then do the 4,000, so this is Queensland, and you can see there how the story evolves. Some areas not too badly off, but as you pull out, you can see Ipswich coming into view, and places further south, and even down to places like the Gold Coast. So it is very significant. And the population density in Brisbane, of course, is lower, but nevertheless, there are still some hot spots that it's worth noting down to the Gold Coast. And then we'll just do 6,000, which is the other one I did. So you have that too. So this is moving out from the centre of Perth where things aren't too bad, but as you move to the north and to the south, what you discover is that you can see quite considerable amounts of difficulty. Remember, I'm measuring mortgage stress, so this is cash flow. Doesn't necessarily translate to defaults immediately, but as I said earlier on, the risk that I see is that defaulting will start. And as I mentioned earlier on, we're seeing quite a lot of defaults in and around Western Australia at the moment in some areas, particularly down some of these areas to the north and south on the coast. And Rockingham, as I said earlier on, likely to be an interesting thing to watch, because there we've got the submarine building going to the submarine housings there, so there could be a significant demand for property. Okay, well, we got through that. Okay, so what I'm going to do now is I'm going to switch my views around, and what we can then do is look at individual postcodes. And just to sort of get the ball rolling, let me show you the Wollongong postcode. I use this one quite often simply because it's quite a useful one. Hopefully make sure that's on screen. Yes, it is. Okay. So this is the Wollongong postcode, and you also sort of get familiar with the way we do it. So we look at the total number of households, 18,000, broken down by those who own outright, borrowing and renting. And we can also look at the percentage in mortgage stress, so 26% in mortgage stress, but 73% in rental stress in this particular area. We've also got 51% of households in financial stress overall. We look then at scenarios. So the best case scenario is a bit of a fall, not dramatic, but there's not much prospect of a rise anytime soon in this particular postcode, and units and houses roughly moving in a similar direction. Talking of that, 30% of houses, 52% of units, and that includes other types of property, for example, properties that are built over the retail sites of places like that. And the people ratio is quite interesting because it shows you the higher the ratio, the big, it's more of a family rather than one or two people. And there was quite a lot of vacancy back when the census was done a couple of years ago now. Gross investment yield 3.4%, net investment yield still below zero, so people are losing money on a cash flow basis. And then if you look at the taxable income, the ATO says about 79,000, the census household said 84,000. That translates to a disposable monthly income of around $5,600, of which 43.9% on average are now going to pay the average mortgage, $2,467, and 35.5%, $1,993 going on the average rent. So you can see here a lot of people still in difficulty, particularly in the rental side of the house. So that's what I can do. Now let me just go back. Okay. Sorry about the mapping problem. We got there in the end, eh? So Jerry asked for 4121 and 4868. So let's go to there. 4121. See whether that comes up. Yeah. So make sure it's on screen. Okay, this is 4121, Jerry, for you. And you can see there that there's 9,800 households, of which 23% own outright, 46% are borrowing, and 29% are renting. 46% of households are in mortgage stress, 7% in rental stress. The overall score on financial stress is 46. The best case scenario is that prices go roughly sideways from here. The base case is slightly less good, and the worst case is significantly worse. Depends on where you think rates are going to go and what the RBA is going to do. Mostly houses, 84%, 11% units, and vacancy rate of about 5%. The investment returns 4.6% gross on average. Net investment yield 0.7. Now, the net investment yield is after you've paid the interest on the mortgage and those sorts of things. And looking at the taxable income, the average from the ATO is 97,000, from the ABS 127,000, and that translates to about $7,499 a month, which means that around 37.6% of the average income is going on the average mortgage, which is more than $2,800 a month, or 27.3%, just over $2,000 going on the average rent. And the other one you asked about was 4868. So we'll try putting that one in. Okay, this is up in Cairns. And there you've got 8,000 households, 25% own outright, 41% of borrowing, 32% of renting, 52% in mortgage stress, a bit of rental stress. Overall households in financial stress a bit lower at 34%. 82% of houses, 8% of units, and the people ratio is a little higher. The gross investment yield is around 4.4, the net investment yield is about 1%, so people are actually making a return on investment properties on average up in that area. Gross investment income, the gross income about 68,000, household 80,000. And that translates to a disposable monthly income around $5,100. And that means that you've got around 35% going on the mortgage, or $1,800, and 34% going on the rent 1,745. And looking at the scenarios, best case scenario is a rise of both houses and units over the next 2 or 3 years. Base case a fall, and the worst case a more significant fall. So it does depend on what happens to those interest rates and scenarios. Okay, just going down the list now. Okay, Sandra has asked for 2640. Okay, so this is West Albury, 2640, 16,000 households, 28% own outright, 37% borrowing, 33% renting, 28% in mortgage stress, 74% in rental stress, overall financial stress 43%. So scenarios would suggest a bit of a fall over the next 3 years because of this high level of stress. And the base case and the worst case even worse, of course. Mostly houses, 81%, few units. And looking at the overall returns, 3.5% for the gross investment yield, but pretty much flat. In other words, not losing much, but not making much from an investment flow perspective. Taxable income around 77,000 from the ATO or 81,000 from the household census. Translates to a disposable monthly income around $5,200 on average, with 34.7% or $1,820 a month going on the average mortgage, and 26.6% or $1,395 going on the average rent. Mega Great Pretender says, great show, thank you. 4069. So this is Ipswich Inner, around Chapel Hill, 12,000 households, 37% on outright, 49% are borrowing, 13% are renting. A lot of stress with 49% in mortgage stress and 100% in rental stress. Now take that with a slight pinch of salt, plus or minus a few percent, but a lot of people are feeling it, and financial stress about 45%. So because of this level of stress, my estimation is that prices are going to slide a little bit over the next 2 or 3 years. And if we get those worst case scenarios, could slide quite significantly. Mostly houses, 95%, almost no units. People ratio is quite high, so it's quite a high family count. Vacancy rate's 4.3, so it's somewhat lower. Gross investment yield 4.7, net investment yield about 1%. And the ATO said 129,000 average individual income taxable, and the census said 156,000 for the average household. That translates to about $9,000 a month, with 33% or just over $3,000 a month going on the average mortgage payment, and 29.8% or $2,691 going on the average rent. Okay. Crazy Ham. VK3 VKE. You are a ham radio operator. I am G8HKK because I got my UK license back. So there you go. I'm also a ham operator. That's something else I do in my spare time. How's about that? Okay. 4870. Okay, so this is far north. Yonder. Around Cairns. 28,000 households, 22% down outright, 35% borrowing, 42% renting, 42% in mortgage stress, 31% in rental stress, overall financial stress about 31. So there's definitely upside potential over the next 3 years for property prices. This is a cumulative view for both units and for houses. Obviously, if things go worse, the base case or worst case, then expect a fall. 59% houses, 25% units, and quite a few other types of property there as well. Vacant 10.7%, which is higher. That may be something to do with Airbnb or maybe second homes. 4.4% gross investment yield, 0.6% net investment yield, and the average taxable income 78,000, which gives us about $5,000 a month, with 37.7%. or $1,220 a month on the mortgage, or 30.3, $1,544 a month going on the average rent. Yeah, Jerry, thanks for that reminder. I didn't see it until a bit later, so I apologise for that. Anyway, we sorted it out now. Daryl says 6210. Okay, 6210. So this is Meadow Springs, Mandurah, my old favourite. 31,000 households, 32% own outright, 39% of borrowing, 28% of renting, 26% in mortgage stress, 69% in rental stress, overall financial stress 36%. There is definitely some upside scenario over the next 3 years, not dramatic, but some for both units and houses. But of course, if the scenarios go negative, then there could be a drop. 81% of houses, 3.2% of units. The vacancy rate is very high, 70.1%. That's a lot of second homes, Airbnb, that sort of stuff. 4.2% is the gross investment yield. 4.2% is the gross investment yield. Net investment yield 0.4%. And looking at the average taxable income, around 87,000. The households reported lower at 63,000. So it's about $4,000 a month, which means that you've got 49.5% going on the average mortgage at just over $2,000, and 36.6%, $1,495, going on the average rent. Thank you for that. Appreciate that. That's a free super chat. Thank you very much. The first super chat. Thank you very much. Really appreciate it. And another one. Thank you for that too. Yeah, just going down the rest of the comments about the map. Anyway, here's one from Rowville. From Nads, I should say, Rowville 3178. Let's have a look at that. 3178. Okay. This is Melbourne. So 12,000 households, 33% own outright, 51% of borrowing and 15% of renting, 90% in mortgage stress, that's a big number, 71% in rental stress, so overall financial stress very high. No surprise then that we expect in our modelling to see prices fall even in the best case scenario because of this high level of stress. And just to explain that the stress level does directly drive some of the scenario outputs. 91.9% houses, very small number of units. 2.76 is the people ratio, so that's people in a household, I'd suspect, rather than individuals. And 3.1% is the net gross investment yield. Net investment yields under 1%, minus 1% negative. And looking at the individual ATO, 77,000. The household was 114,000. The difference between the two is often because, of course, that takes an individual, whereas in fact many households have multiple people working in the household, which is why sometimes there's a big difference between household and individual. 7,000 on average is the monthly disposable income calculated, with 35.1% going on the mortgage, 2,466, and 31.3% at 2,198 going on the average rent. Okay, electron theory 2065. Okay, 2065, which is Narembeen, around Hornsbury. 2065, you got it right. 15,099 households, 22% own outright, 26% of borrowing and 51% of renting, so a lot of rents going on. No stress data, so that shows that people are doing reasonably well. I suspect the income might be quite high, which is probably why they don't have too many cash flow issues, but a lot of renters are in rental stress and a lot of stressed investors, and that's the sort of correlation of high rental stress. So overall household financial stress is 67%. So the scenarios are negative in this particular area, as you can see there, even on the best case scenario. 18% of houses, 69% of units, there's a lot of construction gone on, and including sort of 12.6% in other types of property, including over retail. The vacancy rate's high, 10.2%, and 3.4% with a net investment yield of minus 0.8%. Yeah, the incomes are quite high, 130, 142,000, which means that the disposable income's around 8,000. 43% going on the average mortgage, $3,600, and 35% going on the average rent. Okay, let me go back up there. Okay, John says Kingsgrove 2208. I missed one or two out as well. I'll go back to those I've missed. Sorry, it's a complicated process. There's so many questions coming through. All right, so this is Kingsgrove, location Cogra. 4,500, with 39% owning outright, 34% of borrowing, and 26% of renting. Not much mortgage stress, but the rental stress is very high, and the stressed investors are also showing up, so about half of all households are in difficulty. Therefore, potential falls over the next 2 or 3 years based on the scenarios. 82% of houses, some units, and the vacancy rate's 5.9%. Gross investment yield 3.2%, net investment yield minus 0.6%. That's one of the reasons why the stressed investors is pretty high, 75%. Income 80,000 or 98,000, and that means you've got a disposable monthly income around 4,600, with 67% going on the average mortgage and 53% going on the average rent. So the interesting question is, why is it that the mortgage stress is not showing as a significant number? And I think you'll find that that is because of the particular types of people who are there and the fact that they are able to cope with very high levels of mortgage stress, mortgage repayments. They're just used to it. So I suspect that's part of the reason. And there's quite a lot of fixed mortgages in this postcode, by the way, as well, which may mean that changes ahead. Okay, let me just go back up my list a bit. Okay. Okay, Cookie Boy says Pork Mac 2444. All right, Port Macquarie 22,000, with 37 owning outright, 29% borrowing and 32% renting, 36% in mortgage stress, 84% in rental stress, some investor stress, 46%. So a little bit of a slide expected over the next 3 years for houses and units. 67% of houses, 14% of units. The vacancy rate was 9%, and the gross investment yield is 3.4, with a fall of net investment yield down to minus 0.2. Taxable income, ATO says 73,000, ABS says 67,000, which translates to a disposable income of around $4,300 a month, with 49.3% going on the average mortgage, 2,160, and 43% at 1,918 going on the average rent. Okay, Daryl says, can we look at 6210? We sure can. Okay, we did that one. That's Mandra. Already covered it. Okay. Crypto Pirate says 4184. I'll give that one a go. 4184. 84. Yeah, now this is Russell Island, so 4,300 households, half own outright, 25% borrow, 25% or 24% renting. Low levels of mortgage stress, high levels of rental stress, overall financial stress around 32. Small fall projected over the next 3 years, but that's the best case scenario. The worst case is more significant falls. Pretty much everyone's got houses there. Very high vacancy rates with, of course, a lot of second homes, a lot of Airbnb and holiday accommodation, and also a very low people ratio too, which is sort of part of the same story. Gross investment yield 4.7, net investment yield positive 0.9%. The average income 60,000 based on the ATO or the household at 39, so some interesting variations there, which means that the disposable monthly income is quite low. I suspect these numbers are probably understated based on the types of people and the fact that a lot of it's temporary accommodation. But you can see there that 42% and 51% is what's coming through in the model. So that might be a relatively small sample. Okay, let's go to the next one. I did Rowville. Did I do? I think I did. Oh, did I do Albury? Let's have a look. Yeah, I think I did that one. Emerald 3782. I think I did that one. 3782. Let's have a look. No, I don't think I did this one. So this is Emerald. Now, let me highlight, this is a relatively low count, so a bit cautious with this because, of course, the sampling is 0.5%, which means that essentially you might be slightly understating the scenario with small samples. Anyway, 34% own outright, 57% are borrowing and 7.8% are renting. A bit of mortgage stress, no rental stress, and overall financial stress is quite low. As a result of that, there is potential upside in the best case scenario for houses and units over the next 3 years. Mostly houses. People ratio is quite high, so that's probably families rather than individuals. 5% vacancy rate, and the gross investment yield is 3, the net investment yield is 0.6%. The ATO says the taxable is 81,000, the household census says 110,000, which gives us a disposable monthly income around 6,900. 34.4% going on the mortgage at 2,400 and 27.4%, 1,909 going on the average rent. Keep calm and carry on. 3690. We used to be the happy people. Wodonga. 14,000. 27% own outright, 35% are borrowing, 36% are renting, 52% in mortgage stress, 67% in rental stress, overall financial stress 48%. Bit of a fall expected even in the best case scenario. And looking at houses, 87% houses, people ratio is 2.21 and the vacancy rate 6.5. Gross investment yield 3, net investment yield negative 1.1%. And looking at the ATO data, 68,000, the household census 72, so that gives us a monthly disposal around 4,800, with 34% going on the mortgage or 29% going on the average rent. Okay. What else have we got? Mr. Brindle says Marulbog 3138. All right, 3138, yep. So this is in the Yarra Ranges, 8,500 with 27% owning outright, 51% borrowing, 20% are renting. 35% in mortgage stress, 63% in rental stress, and looking at the scenarios there, bit of a fall but not dramatic. In best case scenario, more significant fall if we go pear-shaped. 95% are houses, and the people ratio is 2.64, that's sort of family territory. 4.3% vacant, gross investment yield 3.4, net investment yield minus 0.3. And the ATO said 72,000, the ABS said 103,000, gives us a disposal monthly around $6,000, 40% going on the average mortgage and 33% going on the average rent. And just remind you, please, that you will be good to subscribe to the channel if you haven't done so, because we do regular shows and always covering a lot of these sorts of issues, and we greatly appreciate if you subscribe. In fact, I got above 65,000 subscribers now for the first time, which is great. So thanks for that. Do subscribe if you haven't joined already. Okay. Scott Murphy says, Petersham, 2049. Okay, this is obviously towards Strathfield. 5,400 households, 17% own outright, 32% of borrowing and 49% of renting. A lot of stress in all the categories there. Overall financial stress at 59, which means there's a potential fall in property values over the next few years, even in the best case scenario. 24% of houses, 50% of units, 25% other types, including living over shops. Vacancy rate's 11%. And the gross investment yield is 3.4, net investment yield 0.3. ATO said 100,600. The ABS said 118,000 as the average taxable income, with disposable income around 7,131, giving 48% going on the average mortgage, or 33.5% going on the average rent. And I've done Emerald, but I can do 4870. Did I do that one? No, I don't think I did. 28,000 households, 22%, 35% and 42%, so a lot of renting and borrowing. 42% in mortgage stress, potential upside, and looking at that, 59%. I may have done this one already, so if I have, my apologies. 25.4%, and the vacancy rate is 10.7, and the disposable income is 5,000 and a bit, 37.7% and 30.3%. Okay. Mitch Wallace says, can I do Coffs Harbour? 2450, sure can. All right. So 18,000, 35% own outright, 33% of borrowing, 31% of renting, and 33% of those borrowing are in stress, 76% in rental stress. So overall financial stress at 43% is a little high. As a result of that, I would expect to see prices drift sideways or down, even in the best case scenario. 71% of houses, 13% of units, a few other types of property too, and the vacancy rate is 8.3%. Gross investment yield 3.4%, net investment yield minus 0.6%, and the average taxable income around 70,000, which is close to the ABS data too, gives a disposal monthly of 4,569, which means that about 45% of income is going on the average mortgage, or 40% the average rent. Ouch. Thank you very much for the super chat. I appreciate it. First super chat. Thank you for that. I really appreciate that. It really helped just to cover some of the costs of what we do here. As I said, don't do it to make a profit, but I do it to make sure that we talk about this stuff because I think it's really important. Okay, Wagga Wagga. 24,000 households, 27% are outright, 38% are borrowing, and 34% are renting. 47.9% in mortgage stress, 71% in rental stress, and some stressed investors too, 48% overall. Bit of a fall, even in the best case scenario. And looking at the houses, 84.9% of properties are houses, 9.5% are units. The vacancy rate is 7.5%, and gross investment yield is 3.4%, net investment 0, minus 0.1%, so pretty much flat. And looking at the ATO data, $75,600, or the ABS says $84,700, which gives us a disposable income of around $5,424, 33.6% going on the average mortgage and 27.6% going on the average rent. And I will just make the point here that, of course, some people are using 30% as a hurdle above which stress is measured. Remember, I'm using disposable monthly income here. A lot of people are using 30% of gross income, which really doesn't tell you much at all. So that's why I don't use it. All right. 3075. Have I done that one, I wonder? I jumped ahead a bit, didn't I? No, don't think so. This is lay law. 8329 households, 37% own outright, 34% are borrowing, 28% are renting, 84.4% in mortgage stress, 74% in rental stress, and overall financial stress of 52%. So more falls ahead, I think. And looking at the mix, 88% are houses, a few units, 6.2%. Vacancy rates 5.5%. Gross investment yields just 2.9%. Net investment yield minus 0.7%. And I'll make the general point about properties for rent in and around Melbourne. A lot of investors are losing money on a cash flow basis. And of course, with values potentially going sideways or down, not good. Taxable income, 63,000. The household census data, 70,000, gives us a disposable monthly income around $4,600, which means 46.3% or 2,130 goes on the average mortgage, and 38% or 1,749 goes on the average rent. Wheelers Hill, 3150. Another one in Melbourne and around Monash. 23,000 households, 42% own outright, 33% borrowing, 23% renting. Bit of mortgage stress, a lot of rental stress at 81%, and scenarios looking as though prices could fall further over the next 2 or 3 years. 81% are houses, 9% are units. People ratio is 2.54, so that's sort of a family context. 8.9% are vacant, and gross investment yield 3.3%, net investment yield minus 0.4%. Individual ATO, $86,000. ABS census, $97,800, which gives a disposable monthly income around $5,988 a month, which gives us 50.1% as the amount going on the mortgage, or $3,000, and 39.9% at $2,392 going on the average rent. $3,000 on the mortgage, $2,392 on the average rent. Whoops. Okay, what else have we got? 6164. Just lost my mouse. Where's my mouse gone? There it is. 6164. So this is including Success and a few other areas around the Hammond Park. 24,000. 14.5% own outright, 60% are borrowing, very high proportion borrowing, 25.1% are renting. Mortgage stress at 39.5%, which gives more than 5,700 households, because of course it's a big proportion. 88.5% in rental stress, overall financial stress significant, 52%, which means even in the best case scenario, a bit of a fall, and the worst case scenario would be more dramatic falls. 86% of houses, 5.5% of units, 2.58, so that's the people ratio, and that suggests families. 5.9% are vacant, 4.2% gross investment yield, 0.4% net investment yield. ATO says 81,000 individual and 114 from the census. So again, multiple incomes from a household there. 35.2% go on the average mortgage at 2,340, or 29.6% at 1,169 go on the average rent. Just answer this question. Yes, I am actually taking account of the rising population. That's adjusted each time that I run the model. Uh, 6164. is success. Did I just do that one? Yes, you asked me twice. Oh, tricky. At least I recognised it when I went into it. All right, that's fine. Okay, here's one. 2902. So Rosella asks for, this is in the ACT, Canberra, 6,200, of which 32% own outright, 45% are borrowing, and 21% are renting. A lot of mortgage stress, a lot of rental stress, overall financial stress at 65%, giving significant falls even in the best case scenario, and risk of worst case falls if things go pear-shaped. 84% are houses, very small number of units. People ratio is quite high, so that's family context again, I think. 4.7% vacant, and looking at the investment yield, 4.2 versus net investment of 0.8 positive. Taxable income, 85,000 from the ATO versus 114,768 from the census. So again, multiple incomes going into one household. And the average disposable monthly income, 7,424, giving a 32.3% or $2,400 on the average mortgage, and 26.8% or 1,993 on the average rent. $3,075. Did I do $3,075? That rings a bell. Have a quick look. Yep. So I've done that one. Wedgetail leather says 4305. 4305. See what we can do that for you. There we go. Okay. This is around Ipswich. 25,000. Only 22% own outright, 36% are borrowing, and 40% are renting, of which 63.8% of those with a mortgage are in mortgage stress, 80% in rental stress, and overall financial stress at 58.9%. Bit of a fall in prices over the next few years, and looking at the houses, 86.3% are houses, small number of units, and the vacancy rate 6.7%. Investment yield 4.2% gross and 0.5% net. The ATO said 67,000 for the average taxable income. The ABS said only slightly higher at 73,000, and that gives an average disposable monthly income around $4,900, with 33% going on the average mortgage, 1,664, and 30% go on the average rent at 1,495. Can you do 4677? If I haven't done it, I'll do it. 4677. Now, that's Agnes Water. Now, I must tell you, this is a very, very low count, so we've got to be really cautious here, to the point that I really have very little good information. We know that 43% own outright, 30% are borrowing, 20% are renting. Not much mortgage stress, but that may just be low sampling. Nevertheless, I think that because of this low stress and the low count and low population, there is significant upside potential in this particular postcode over the next 2 or 3 years. On the best case scenario, less good on the other two. 89% of houses, a lower people ratio, so that's perhaps more individuals rather than families, and the vacancy rate is 31.3. Now, of course, this highlights that this is almost certainly a holiday area, maybe Airbnb, short-term rentals, those sorts of things. Gross investment yield is 4.6, net investment yield 1.2, so investors are not doing too badly here. And looking at the taxable income, the ATO said 73,000, the ABS sensor said 55,000. So again, low sampling rates coming through here, and it gives us 54 and 45, but those are very difficult to validate. So that's as much as I can really say on that one. I speak woke. Very good. 7252. Another low count one. Oh dear, this is in Tassie. Just over 1,000 households. So very low sampling, but you can say 47% right, 44% of borrowing, very low levels of rent. Not a lot of stress. As a result of that, chances are there could be an uplift in the next 3 years, particularly in year 3. This is cumulative. Almost all the houses. Very high vacancy rates. So again, you've got this population problem based on rentals and Airbnb and those sorts of things. But the gross investment yield is 4.8, net investment yield is 2.1. Income's around 74 to 84, depending on where you look. And the disposable monthly income is around 5,000, with around 31% going on the average mortgage and 26% going on the average rent. But as I say, very low count, so be cautious on that. Okay. $2.08. I'll do that one for you. This is Chippendale, 4,800, 9%, 15% borrowing, 74% renting. So this is our rental speciality. 83% of those in rental stress, significant potential falls in value. And looking at this, mostly units, and a very high vacancy rate, 17.3% vacancy rate. So now some of that could be short-term accommodation, or it could be a lot of new development not yet populated. But generally in some of these suburbs, we do find very high vacancy rates in high-rise apartments. 3.8%. The gross investment yield, net investment yield 0.3, and looking at the taxable income, somewhere between 86 and 90, and that gives us $6,200, with 50% going on the average mortgage and 42% going on the average rent. We did that one, didn't we? $6,062 said River Page. 6062. This is Morley, in the district of Stirling, Western Australia. 13,800, 33, 39 borrowing, 26% renting. Rental stress 66, but the mortgage stress is higher at 72. Bit of a fall then over the next 3 years in the best case scenario. 83% houses, and vacancy rate 6.9%, with 3.7% and not much in terms of net investment yield. Incomes 72 to 84. Gross translates into a disposable monthly income around 5,400, with 39.1% and 32% respectively on mortgages and rents. And a good comment here from Baxter Bisbrook. I'm sorry, it makes me so mad hearing about all the vacancies when there's so much homelessness and lack of housing. Yeah. Now the vacancy rates, of course, are often in areas out of town, holiday areas, etc., etc. But there's more than 1.2 million vacant properties in Australia that could actually be perhaps harnessed if, in fact, we were serious about it. But you wonder. Lee, thank you very much for the super chat. Really appreciate it. I think that was your first, so thank you for that. Greatly appreciated. Steve said 4053. How are we doing for time? We're pretty much out of time, unfortunately. So I may not get through all of them. Anyway, we'll see how far we can get through. 19,000, this is McDowell in Moreton Bay. 19,000 with 23%, 40% and 36% respectively. So 40% of borrowing, 45% in mortgage stress, 91% in rental stress. Overall financial stress is high, so prices may be on their way down in the short term. 76% of houses, 11% of units, and vacancy rates 5.6%. A little bit of gross investment return at 4.5, net investment yield at 0.7, 83,000 from the ATO, 111,000 from the ABS, giving a disposable income of around $6,100, with 36% going on the average mortgage and 30% going on the average rent. Okay. Thank you for that. Appreciate it. Oops. Now what's happened? $2,765. Riverston, near Windsor. Thank you for the super chat. 14,000 with 12% outright, 63% of borrowing, 24% of renting. Very high levels of stress. 88% of households overall in financial stress, which means that we've got significant potential risk of downside movements in property prices. 90% of houses. The people ratio is very high at 3.08, so again, expect that to be families and large family groups. 4% vacant. Investment yield is 3.5, net investment yield 0.6, and the average taxable 81. The household census 113, so again, you can see two incomes going into one property. Disposable monthly income around 7,000 with 47.5%. Ooh, 3,280 going on the average mortgage and 37.8% going on the average rent. Brings tears to the eyes, doesn't it? Oh dear, oh dear, oh dear. Okay, now I'm just going to look down for those who actually super chatted me. Tamworth from Mitch. Did I do Tamworth? I can't remember. 2340. Don't think so. So we'll do Tamworth. 20,000 with 30 outright, 35% borrowing, 34% renting, and high levels of stress. So 68% overall. Price is likely to fall ahead. And looking at the mix, 86% houses, small number of units. Vacancy is 8%, that's quite high really. And the gross investment yield is at 3.4, net investment yield is minus 0.8%. And the ATO says 70,000, the census says 76,000, giving a disposable monthly around $5,000, with 36.5 going on the average mortgage at 1820, or 30% going on the average rent at 1495. Okay. $4,350. That's Toowoomba. So Toowoomba, of course, in my hot list. 47,000 households, 28% own outright, 33% of borrowing, 38.5% renting, with 78% in mortgage stress and 68% in rental stress. Overall financial stress, 58%. Potential falls ahead, therefore. 76% of houses, 5.3% of units, 18% other types of property. Vacancy rate's 8%, and the gross investment yield's 4.2, net investment yield 0.6, and the average taxable income 74,000. So not so many two-income households here. Disposable monthly income around $5,000, with 35.8% going on the mortgage, or 30% going on the average rent. Cookie Boy's gone. See you, Cookie Boy. Thank you for that. And I know you're up early these days, so I appreciate your coming in. Okay, I'm going to close the show in just a couple of minutes, but I'll just do this one. 4122 Mount Garrett East, 17,000, and 25% of borrowing only outright, 38% of borrowing, 36% of renting, 46% in mortgage stress, 7% in rental stress, and overall financial stress at 50%. Bit of a fall in property prices likely ahead. 71% in houses, 60% in units, Vacancy rate's 5.4. Gross investment yield 4.5%. Net investment yield 0.8. Looking at the ATO data, 77,000 compared with the ABS at 100,000. And that gives us a disposal monthly around $6,200 with 38.2% or $2,400 going on the mortgage and 32.9% going on the average rent at just over $2,000. Okay, so I am pretty much now out of time. So what I wanted to do was just close out the show, which I'll just go back to there, and where am I going? To there. No, hang on, sorry, just 1 second. Get my sort myself out. I've got too much going on here. Oh dear. Would help if I picked the right thing, wouldn't it? Yeah, okay, good. So if I go back to there, and then go to there. Right, just to close out the show, I would just make the point, of course, that people often get into severe difficulty as they try to struggle with all of these pressures. And I caution people about what they should do. Be careful about just Googling on the internet, saying, financial help, those sorts of things. You end up with people who will charge you to doing things. But there is a national debt helpline. It's on 1-800-007-007. And they've got some expert financial counselors. They're extremely busy at the moment, but to make a note of that number if you need help. You need to understand your financial footprint, money in, money out, where you can prioritize. Have you got the very best interest rate that you have on the mortgage? All of those sorts of things. And I discussed that earlier in the week with one of my other guests. So go check that show out too. In terms of what happens ahead, I will just make the point that if you want to get detailed information, as I've shown you this evening, this is actually available via our Patreon. And our Patreon service has a different selection of tiers, and I appreciate all of those who support us via Patreon. It really is critical. But if you want to get hold of the full data set that I've been going through this evening, it is available. There is a subscription. It's $50 a month plus GST, and you can go across to the Patreon channel and join up. And for as long as you sign up as a member, you then get the monthly data set pretty much around the time of this show. So you can compare and contrast. And there's a lot more information than I can make on the show, of course. More than 2,000 postcodes covered in the story. So that might be worth thinking about, and appreciate all those who actually support me via the Patreon program. It really does make a huge difference to us being able to do what we want to do. And finally, let me then say that next week I have Leith back on from Macro Business. LVO, of course, very much part of the macro business community and very much focusing on things like high migration, all those things. So he's going to be back on, and we'll be able to have some chats next week about some of the other significant issues that are going on in the marketplace from an economic perspective. So join us next week on that show. Again, it'll be 8 p.m. Sydney time as normal. And if you didn't get your postcode request answered in the show tonight, and I apologize I didn't get through all of them, but hopefully I got through most of them, you can send me a message using the little app on my blog, and the blog link is below. If you ask for a particular postcode via the blog, over the next few days I will send you the one-page picture that I actually presented to everybody this evening for a particular postcode, because I recognize that quite often it's impossible to cover all of the areas that we want to cover in one show. Anyway, thank you very much for spending some time with them, Sim. Really appreciate it. Hope you got something out of it. I do think we're going to see more pressure on households ahead. So if you're in mortgage stress, don't just ignore it. Be proactive. Think about cash flow. Think about what you can do to vary your cash flow. And remember, of course, the banks have an obligation to assist, although sometimes the recommendations they make are actually more in their own interests rather than the interests of their borrowers. But that's a whole nother story, which I'll come back to in a future post. So thank you very much for spending some time with us this evening. I look forward to seeing you next week on the live show, and check out my recorded shows in the week meantime. And once again, thanks for all those who subscribe. If you haven't done so, do remember to subscribe. We've got now 65,000 subscribers, which is great, and still growing. So keep subscribers up, and that helps to spread the word of what we're doing here. So thank you very much. take care, have a good evening, and I'll look forward to seeing you in the next show next week. This is Martin North from Digital Finance Analytics, signing off. Cheerio.